The Board of the Securities and Exchange Board of India on Tuesday gave its approval to phasing out buybacks done through stock exchanges. This route will be completely phased out by March 2025. After the board meeting, Sebi chairperson Madhavi Puri Buch said that the Sebi board felt that the tender route was a more equitable one for buybacks, while the other route was vulnerable to favoritism. A buyback is a corporate action where a company buys back its shares from existing shareholders, usually at a price higher than the market price. Buybacks can be carried out in two ways. One is the tender route, where shareholders may be presented with a tender offer, whereby they have the option to submit a portion or all of their shares within a certain time frame and at a premium to the current market price. The other is the stock exchange route, where the company buys back shares on the open market over an extended period of time. A buyback may be executed for various reasons. It can be to provide an additional exit route to shareholders where shares are undervalued or thinly traded. It can also be to return surplus cash to shareholders and support the share price during periods of sluggish market conditions. So, how will shareholders be affected by Sebi gradually phasing out share buybacks through the stock exchange route?
The tender method is the most favorable method of buyback from an ordinary shareholder's perspective, especially the retail shareholder. Whereas the market buyback was generally abused by the managements to manipulate the sentiment when the stock was under pressure. So I welcome this latest move by Sebi. It would have been better if they had abolished it from the next quarter itself. However, it's good that they have increased the minimum buyback limit and are creating a separate window for such market buybacks.
Sebi has given its go-ahead to increase the minimum utilization of the amount earmarked for buyback through the stock exchange route from the existing 50% to 75% until the route is completely phased out. Until then, buybacks will be executed through a separate window on stock exchanges. The markets regulator will also permit the upward revision of the buyback price until one working day before the record date. Furthermore, the period for completing the buyback offer will be reduced from 6 months to 66 working days from the 1st of April 2023. It will be further reduced to 22 working days from the 1st of April 2024.
In the general market window, anybody can be a buyer, whereas sellers are those who are registered shareholders or short sellers. But in the special buyback window, there can only be two groups. Buyer is the company itself and nobody else. And the seller has to be an eligible shareholder who will have to deliver the shares at the end of the day, since there is no square up mechanism in the window. And since the company will now have to complete the minimum fulfillment of 75% of the planned buyback, there will be pressure on the company to pay a premium on the market price to achieve this target. Although complete details of the window operation is not available, I assume it will be accessible only to those eligible shareholders as on the record date.
Overhauling the governance mechanism, Sebi has also laid down measures to increase transparency and accountability at market infrastructure institutions like stock exchanges, depositories, and clearing houses. Under the new framework, board members and key management personnel will be held accountable if they do not report any wrongdoing that they are aware of. A sharper code of conduct will also apply to market infrastructure institutions, key management personnel, and board members. An internal evaluation of market infrastructure institutions will have to be conducted every year, while an external evaluation will be conducted once in 3 years by an independent entity. Furthermore, the institution's chief regulatory officer will be required to submit a quarterly report to Sebi on non-compliance, if any. Market infrastructure institutions will also be required to frame an internal policy for sharing and monitoring data.
This move by Sebi and its board will definitely benefit shareholders and investors, as it will bring much more clarity and sharpness to the day-to-day functioning of the MIIs. It also reduces the risk of challenge for future actions, as we have seen for certain institutions in the last few years. And more importantly, KMPs will be identified and have to take responsibility, but arguably this will avoid conflict of interest for them because they will be focused on either the critical functions of the stock exchange or the regulatory and compliance functions or other functions. Hence, overall, this is a positive move which will bring more clarity to the functioning of these MIIs, and that will result in better returns and better governance for an organization, which always benefits shareholders of such organizations.
The SEBI board also decided to designate stockbrokers based on identified parameters as qualified stockbrokers. These stockbrokers will need to comply with enhanced risk management practices and requirements. About 16 brokers will fall under the qualified stockbroker category under the suggested parameters. The regulator will also provide an investor risk reduction access platform that will help clients in squaring off risks in the event that the trading services provided by a broker are disrupted. It is expected to be available from the third quarter of FY24. SEBI's decisions should streamline the buyback process and create a level playing field for investors. The steps to improve governance at market infrastructure institutions are also significant given the past failures and controversies at the National Stock Exchange and Multi-Commodity Exchange.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.